The next financial crisis won't come from housing. It won't come from the banks. It's going to come from the very technology that's supposed to save us. Artificial intelligence. Everyone's celebrating the AI boom right now, record profits, trillion-dollar valuations, CEOs talking about the new industrial revolution. But what if I told you this revolution is quietly building the most dangerous financial bubble since .com 2000, and this time, it's tied to everything? I'm Khalid, from Cyrus Vault, and today, we're breaking down why the AI gold rush might trigger the next global crash, one that could erase trillions in paper wealth, while creating generational fortunes for those who see it early. Let's begin. Everybody remembers the .com boom. The late 1990 seconds felt unstoppable. Every company adding .com to its name doubled overnight. Investors believed the internet had rewritten the laws of economics. Sound familiar? Today it's AI. Chip makers, data center REITs, cloud providers, they're all priced as if they'll dominate forever. Nvidia's market cap has eclipsed entire countries' GDPs. Companies that merely whisper the word AI in an earnings call see their stock jump 20% in a day. But here's the dangerous truth. The profits driving this euphoria are concentrated in less than 10 companies. The rest are running on hope, and just like every previous boom, when hope becomes collateral, it ends in pain. The media shows you gleaming data centers and humanoid robots, but what they don't show you are the balance sheets behind them. Every one of those AI miracles runs on debt. Corporate debt funding billions in chip orders, government subsidies chasing tech supremacy, consumer credit powering record hardware sales. The same pattern appeared before every crash. Asset prices soaring while productivity stagnated. In 2000, it was internet eyeballs instead of profits. In 2008, it was housing values instead of income. In 2025, it's AI tokens instead of cash flow. We're living through the first data collateral bubble, where companies borrow against projected training data value. Think about that. Not oil, not land, not factories, but data sets. That's like borrowing money because you might find gold in a mine you haven't dug yet. To understand why this can't last, follow the power bills. Training a frontier-level AI model can cost over $1 billion in electricity, chips, and cooling alone. Data centers already consume more energy than some nations. If AI really scales 100 times, we'd need entire new power grids, and those take decades, not months. Meanwhile, central banks are stuck. They can't hike rates without bankrupting these highly leveraged tech giants. But they can't cut rates either, or inflation reignites. That's the AI capital expenditure trap. An economy addicted to a single sector's spending. The moment AI capital expenditure slows, global growth drops with it. Sound dramatic? Remember, 2008 housing was only 8% of GDP, but when it cracked, everything fell. AI and tech now represent over 30% of the S&P 500's value. Do the math. What most people miss is that the AI boom sits on two layers of leverage: corporate debt and stock buybacks, companies issuing debt to repurchase shares, inflating earnings per share metrics. Derivatives and ETFs, billions in passive funds, automatically pouring money into the same few stocks every payday. That means your 401k, pension, and index fund are all accidentally leveraged to the same AI narrative. When sentiment flips even slightly, those flows reverse. ETF selling triggers margin calls. Margin calls trigger credit tightening. And credit tightening crushes every sector dependent on cheap money. This is how contagion starts. Not through one company failing, but through liquidity evaporation. It's the same ghost that haunted 2008, just wearing a new mask, a digital one. Now, here's where it gets really serious. All this AI madness is denominated in dollars, but the rest of the world is starting to question the dollar's monopoly. BRICS nations are building payment rails that bypass SWIFT. Gold reserves are rising for the first time in decades. And major corporations are holding Bitcoin and stablecoins on their balance sheets as insurance. Why? Because they see the same thing we do: a global financial system so concentrated in US tech valuations that if the AI bubble bursts, the dollar could be the next domino. That's the meta bubble. The bubble of belief that the system itself can't break. But history says otherwise. Rome thought its currency was eternal. So did Britain under the pound sterling. Every empire ends the moment its money loses trust. You'll know we're approaching the cliff when you see 3 signals. Retail mania influencers teaching AI get rich quick courses. Check. Politicians claiming AI will erase debt and poverty. Check. Companies pivoting to AI out of desperation. Watch when your grocery chain announces an AI division. We're already there. Every bubble ends the same way, with overconfidence and denial. The dot-com era had pets.com. The crypto boom had Dogecoin on Saturday Night Live. This cycle, maybe it'll be a humanoid robot ringing the bell on Wall Street while the real economy quietly burns below it. So what do you do when the bubble isn't in stocks or real estate but in belief itself? You hedge against narrative risk. That means owning assets with intrinsic value, things that don't need marketing to be valuable. Gold because you can't print it. Bitcoin because you can't dilute it. Productive businesses because they solve real problems for real people. Diversify globally. Hold some cash for liquidity, but don't confuse cash with safety. And most importantly, educate yourself about how these cycles actually work. Because in every crash, the wealth doesn't disappear, it transfers from the uninformed to the prepared. When you strip away the hype, AI is transformative technology, but technology alone has never abolished the business cycle. This boom will create winners and losers like every era before it. The question is, which side will you be on? The next 5 years won't just decide who profits, they'll decide who owns the future of money itself. So, if you want to see exactly how AI and de-dollarization intersect, and what assets can thrive when the system flips, watch my next video right here. Until then, this is Cyrus Vault, where ancient wisdom meets modern finance. Stay smart, stay sovereign, and as always, protect, grow, conquer.